Hello, and thank you very much for joining us for today's FBF online seminar on securitization in Europe. Jean-Jacques, the floor is yours.
Thank you. Thank you very much. I had a few technical issues, but anyway, welcome to everybody on today's online debate organized by the Florence School of Banking and Finance. The topic today, I think, is self-explanatory: securitization in Europe, the way forward. My name is Jean-Jacques von Helten, and I am a fellow at the Florence School of Banking and Finance. And I will be chairing today's meeting, today's seminar, and the debate. But before we do, first of all, let me just introduce the speakers in the order in which they will speak to the particular aspects of securitization within Europe that is of interest to them. First up will be Pablo Portugal, who is a managing director at AFME, which, as you all know, or most of you know, is the Association of Financial Markets in Europe, based in Brussels. He's also a member of the board of the European Capital Markets Institute. And among the topics, which I think will be of great interest to all participants, Pablo will be considered the extent to which the ambitions of a vibrant European securitization market, which we all talk about, are still being fulfilled, or whether they can be fulfilled. So very much looking forward to his input. Bertrand Chavasse works at BNP Paribas, the next speaker up, and he focuses on risk regulatory strategy, which, needless to say again, is at the heart of the securitization process. So welcome, Bertrand, notably in respect of STS, of course, which was established to develop a securities market, that's for sure. Next up is Patrizia Canziani, more than 20 years experience in the financial markets. Welcome, member of the SOGEFI's Group Board Risk Committee. And she really doesn't need any introduction, at least not for me and many participants, because of course she's been a very valued participant and discussant in the FBF's earlier securitization online course. And then last but not least, Bart Joosen from Vrije Universiteit Amsterdam, whose areas of expertise are manifold, but they include financial services supervision, and particularly with respect to securitization, the usefulness of STS securitization for SME loans. So thank you all for participating, in which will, I hope, will be a very exciting debate. Now, each of the speakers will speak in the order that I've introduced them for about 7 minutes or so. And for those dialing in, I would ask you to not use the chat box if you have any questions, but use the Q&A box at the bottom of your Zoom screen. And then if you have questions, can you please indicate which of the speakers you'd like to address it to, or if it's a more general question along with others, I will try and collate that and put that during the debate to the panel as a whole. Finally, 2 points. Throughout the seminar, we will be launching a number of online polls, questionnaires on securitization, and we'd like your feedback on that very much, our multiple choice responses. And they will be done in between the speakers. So if you could, a total of 5 questions will be displayed in the transition. And then last but not least, a bit of raising awareness that we're going to do a course on securitization at the FBF, which we strongly encourage you to participate in. We're launching that on the 11th of January next year. It'll be Zoom-based, unfortunately not in Florence, which is a pity, but nonetheless, if you could bear that in mind as well, it'll be advertised on the FBF website imminently. And with that, and without further ado, over to Pablo.
Thank you very much for that introduction, and thank you to the FBF for the invitation to be in this debate today. I would like to start with a couple of slides discussing the state of the securitization market. So I'd be grateful if we put them up. Thank you very much. So if we move to the second slide, thank you. I just wanted to show here that the securitization market in Europe remains subdued. As we can see, the issuance levels are a small portion of what they were pre-crisis. We can see the levels in 2007, 2008, 2009, and how there's been a downward trajectory. If we turn to 2019, that was the last year the STS framework went live in Europe, the new framework. We can see a kind of a drop in the issuance levels compared to 2018, and kind of a reversal of the modest positive trajectory we had seen the previous years. And we think that is due to the new framework being complex and requiring time for the industry to adjust to it, and issuance was kind of slow. The new framework had a slow start, also because not all the regulations, the kind of regulatory standards were fully in place at the time the framework went live. So that was there were challenges for the industry in terms of understanding all the details and being ready to comply. But that was last year, and of course this year we had the pandemic, and that has affected again the volumes. There are different reasons for this. I think Bertrand will talk a bit more about this, but from our perspective, one consideration here has been the ECB purchase programs and the support they have provided in different fixed income markets, government bonds, corporate bonds, covered bonds. And in relation to securitization, we've noticed that the kind of the level of ECB engagement in the ABS market has been much less, and that has affected liquidity. That affected liquidity in the market, at the peak of the pandemic volatility earlier this year. So obviously there's been an impact there, and we can see the levels in 2020 are, I would say on track to be less than 2019. These are the numbers, as of November this year. So fair to say then that the market has not recovered from the crisis situation. It remains subdued in Europe. I'll talk a bit more about our thinking around that. Perhaps we can move to the next slide. Here, I just wanted to show a little bit the STS issuance statistics to date. As we can see there, last time I checked yesterday, 401 STS issues, 226 private transactions. Those are the ones not subject to a prospectus, and 175 public transactions. If we look at the asset classes, clearly RMBS, residential mortgages, and auto loans, leases, dominate the kind of underlying issuance asset classes. You can see there SME loans is very small at 2%, and that kind of reflects the difficulties that we have in securitizing SME loans, and that's why having a good framework for synthetic securitization is important, because that is a way to incentivize lending to SMEs and using securitization techniques for that purpose. So I'll say a bit more about that. And if we look at the kind of country breakdown, clearly the UK, the dominant jurisdiction there, and followed by Germany, the Netherlands, Italy, France, and the other countries. So I think I also wanted to mention this is noting the STS levels, but in terms of non-STS, issuance is roughly 2 times greater than STS, so than what we see here. So that is important, because there are a number of asset classes, for example, CLOs, CMBS, NPL securitization that don't qualify as STS. And in some of those areas, issuance has is much higher than STS. In the ideal world, it should be I would say the opposite, because the whole point of STS is to kind of increase the size of the market, of that part of the market, and to, for that to become the mainstream. But that has not been the case so far, and the STS market has been slowly growing, but it's still not taken off, I would say, as much as we would have liked. So if we can move to the next slide, that's what something I wanted to focus on in my intervention. Why has the STS market not yet taken off? Why haven't we seen a big return of the investors that left following the crisis, a big kind of scaling up of issuance levels, etc.? Well, there are different reasons. I'm going to focus here on regulations because we think the regulatory framework has been a significant factor. But there's also, of course, the macroeconomic environment that affects securitization and all other financial instruments. There's the impact of the pandemic as well. What I mentioned is also on liquidity support by the ECB. That's important. But I'll focus now on regulations, and we still think that despite the good intentions of the STS framework, not enough has been done from a regulatory perspective to correct some of the excessive regulations we've had following the crisis that basically disincentivize issuance and investment in securitization. From our perspective, the whole concept of having a set of, I would say, best-in-class securitizations, the simple, transparent, and standardized, standard of securitizations, that concept is very welcome. We very much support it, but that should be accompanied, once we identify the best in class, that should be accompanied by a more proportionate, risk-sensitive regulatory treatment for those securitizations. And that has not been the case. And we think that some of the calibrations, some of the regulations remain punitive and don't take into account the strength of the STS label. So I've mentioned here some of those. The prudential treatment of securitization for bank and insurance company investors remains quite punitive, I would say. And these are key investors in the European market. Banks invest in each other's securitizations, and insurance companies are a key player, or should be a key player in the European market. And from our perspective, the Solvency II calibrations for insurers, for example, do not incentivize enough investment in securitization. When the STS framework was adopted, the Commission revised the Solvency II calibrations for insurance companies, but only for the kind of top tranches of STS, and not enough. Nothing was done in relation to the non-senior STS tranches, the mezzanine tranches, where we think insurance companies would be good investors for that segment of the market. On the other hand, the Solvency II calibrations incentivize insurance companies to buy whole loan pools that are not securitized, and we don't understand why that is the case, because in principle a securitization is an instrument with credit enhancement, with more liquidity, and that should be reflected in the calibrations, and that's not the case at the moment. So that is one. Another point that is very important is improving the process for banks to achieve significant risk transfer. The process is quite cumbersome, and on Monday the EBA published a report on this that we're still studying, but that is going to be we think an important work stream to kind of streamline SRT process, and I think Bertrand will also talk about this. The liquidity coverage ratio, again, when the STS framework was adopted, we were hoping to see an improvement in relation to the liquidity treatment of STS securitizations, a sort of upgrade in the LCR liquidity treatment, but that was not the case. So the senior tranches of STS securitization remain at level 2B in the LCR scale. Covered bonds, for example, are at level 2A, and we would have liked to see an upgrade. We think that is warranted given the strength of STS, but that has not been the case. So it's another example. At the moment, the European Union is negotiating a capital markets recovery package that includes 2 proposals on securitization. One is the establishment of an STS framework for synthetic securitization. We very much welcome that. That is an important element, we think, to help in the crisis response and enable bank lending to SMEs. The negotiations are all ongoing, but from what we have seen, we are seeing a number of kind of unhelpful requirements being added to the framework, and again, that risks making it uneconomical for banks to use. But the negotiations are ongoing, so we will see where that ends up. And there has also been a proposal to adjust the capital treatment of securitizations of non-performing loans. Sadly, we expect that the level of NPLs will go up following the current crisis that we have, and securitization could play a big role in helping with the NPL workout. So it's good to see the intention to have a more proportionate capital treatment, but we need to see where this ends up as well. There is going to be a Basel standard published very soon on this that the industry is watching closely. One challenge for the industry was also the implementation of the new disclosure templates that were stipulated in the STS regulation. Here again, we would like to see more proportionality in relation to these templates, which are very cumbersome and kind of especially for securitization. Among all the fixed income asset classes, securitization has a more stringent transparency requirements among all of those. And finally, we think the market for ESG securitization or green securitization is a promising one. We think that is an area for development given the EU focus on sustainability. So this market would benefit from having a kind of a common standard for green securitization, some definitions that are standardized. So I would say that is a future work stream as well in the securitization area. So I will stop there and of course look forward to debating with the colleagues.
Thank you very much, Pablo. Before we pass on to Bertrand, it always amazes me that in my years in dealing with regulators, their ability to be able to come up with at least 6 barriers that you've listed and not work collectively with the industry and make it hard to actually implement changes in the markets is something that no doubt we'll come back to in the course of the debate. So I'll pass, given time constraints, Bertrand, over to you.
Can you hear me?
Yeah.
Okay, thank you. So thank you, Jean-Jacques. Thank you to the FBF for inviting me to this debate. I will start with a short point on the STS markets. So as you have in front of you the two slides showing the volumes of ABS and RMBS. What we can say, and if we compare it to the second slide, is that there is somehow a convergence between, say, the securitization market and especially ABS markets with the STS label, somehow since 2019 and with the introduction of the STS concept, progressively issuers have converged to the issuance of STS labeled transaction, and you can see the volumes on the second slide. And what we can say is that indeed, and this was also described by Pablo, there is a reduction of the volumes of issuance since in 2020. We can say obviously that is due to the pandemic situation, or mainly due to that. What we've observed is that there was a spread widening in March following the first lockdown, and there is an ongoing tightening of the spreads after the summer, which is not over yet. So this explains this reduction of issuance. There are other reasons for those lower issuance in 2020. Is that there was obviously lower origination as well, lower production of new loans, especially for auto loans during the lockdown period, but also consumer loans. So there was less asset to securitize. There was also somehow a competition of issuance with the ECB TLTRO program, which was providing cheaper funding than securitization. And maybe this is not a single explanation, but potentially an effect also of state guaranteed loans, which has reduced the needs for securitization, at least for capital relief. The other point that I wanted to mention is, let's say, on securitization in general, and give the point of view of a bank, is that securitization is one of the tools that are used by banks to get funding on one side, but also used to transfer their credit risk. And what we can observe at the bank is that securitization is significantly scrutinized by regulators or competent authorities or supervisors when it is used as a tool for capital relief. There is a huge regulatory burden for banks when they want to securitize those assets. And I would say this regulatory burden is not commensurate with the one that we can have when banks are using other tools to transfer risk. I take the example of the CDS single names or guarantees. We don't have the same regulatory scrutiny when we are using such instruments to transfer the risk. As an example, and I will give you this one, there is a long process for, say, a review by competent authorities, which have to analyze each securitization transaction that aim to release capital. This is a long process. This creates uncertainty on the issuance, and sometimes it's not inadequacy with the timing for the issuance on the market. There are also a lot of regulations around securitization, at least for banks, but also for third parties. I can take the example of the interest alignment. You know, banks have to retain, or originators have to retain, a part of the assets which are securitized in order to align their interests with investors. This was a response to the 2007-2008 crisis. There is some due diligence requirements which are not required for other kind of assets. There are some requirements on credit granting as well, the way banks have granted credits that they are securitizing. There is also a point mentioned by Pablo, which is very important, which is the non-neutrality of the capital requirement for securitization. What does it mean? It means simply that if you are, say, securitizing assets, and if you are retaining all the tranches that have been issued in the securitization, you have a capital requirement which is 2 to 3 times higher than the capital requirement of the underlying asset. And this is due to the over-calibration of, say, the formula for determining the capital requirement of securitization, say, post-issuance. And this non-neutrality has been inflated in 2017 when we have introduced, or when Europe has introduced the Basel Standards, which have been negotiated in 2014. And in fact, those Basel Standards have been hugely inspired by the US rules. These were the methodology used by the US regulators, which have been transposed to the Basel Committee and then in Europe. Other aspects of this, let's say, huge regulatory scrutiny is the regulation on rating agencies, which has been modified to take into account the consequences or the lessons taken from the 2007-2008 crisis, the securitization regulation as well, which has introduced the STS framework, the disclosure requirement, etc. So this being said, we have observed efforts from, say, both competent authorities and regulators to facilitate securitization. On one side, competent authorities have provided huge efforts to smoothen the way they were analyzing transactions and to facilitate the issuance. We have seen also the introduction of the STS framework for cash securitization, and now this being extended to synthetic securitization, which is a good thing. However, we are not sure that the objective will be reached if those standards are too prescriptive, and if they don't fit to the good practices of the market. Today, it's not obvious. There are a few points which are of importance, which are not, perfect or fitted to the bank practices. We have seen, and Pablo mentioned it earlier, the issuance of the EBA report on significant risk transfer. So in order to harmonize the practices, to add precisions on the measurement of risk transfer. We are still analyzing it, and we cannot say that. I cannot give you a full opinion on that. But from what I have seen, it does not solve some issues that we have seen on excess spread, and I would say here especially on cash securitization. So I would say in conclusion, I would say that what we observe is that there seems to have a suspicion on the securitization product from lawmakers and maybe supervisors. So indeed, there was a crisis in 2007, 2008 on securitization. This crisis had revealed a huge lack in the regulation, and it was a Basel I regulation. But since that period, we observe a never-ending inflation of regulation on securitization instruments, while even Basel II had already eliminated a lot of potential incentive of regulatory arbitrage. And what we see is that there are a lot of initiatives to restore securitization. As I said, STS is an example, but often we see in addition to those initiatives, some increasing regulations. So there is things to improve it, but they are always accompanied by increasing regulation and sometimes burden regulation. So I think that maybe a good balance should be found. Maybe we are now over-regulated. The securitization is over-regulated, and maybe a good balance should be found between, say, a situation pre-crisis, which was indeed maybe not acceptable, and a situation today where, when you compare it to other asset classes, securitization seems to be hugely regulated.
Thank you very much, Bertrand. It's actually interesting that both you and Pablo have made a point about the regulatory burden that is significantly higher for securitizations as an asset class, and it's kind of like you were saying. It sort of swung from very little oversight and control pre-crisis, financial GFC that is, and now it's the pendulum has swung the other way. And I guess any thoughts on how we're going to get and move this forward? I mean, if it looks like the STS market, securitization market is, well, it's not quite moribund, but it's not, it's not flowering, let me put it that way. Any thoughts on how you could do that briefly? How can we solve the conundrum, as it were?
Maybe I don't know if Pablo will have an opinion. I think that's if we are talking about securitization as a tool for risk transfer, I think that we need some incentives to use this tool. So I would say 2 points. I've mentioned it. The way that risk transfer is measured. I think we really need to smoothen the process for risk transfer measurement. ZBA has proposed a solution. I think that there is also a point on the role that we are giving to competent authorities, and what we are trying to push is to have, let's say, two kind of process. One which would be for, say, a fast track process to go faster and simpler in terms of interactions with the supervisors. Another when it comes to complex securitization, which would be which would need indeed a scrutiny from regulators or supervisors. And the other point is that the calibration, the capital calibration. As I said, it's too punitive and it does not incentivize banks to use it.
Yeah, I think that's right. Pablo, any comment from you before we move on to Patrizia?
Thank you, Jean-Jacques. I would echo Bertrand's comments. The question of incentives is really key. This, like any market, this market needs, the incentives to be there for banks, for the issuers, and for the investors. And at the moment, the economics don't work for many of the key participants. So banks clearly, use securitization to free up balance sheet capacity. They use it for funding, for risk management, but they need to be incentivized, and through the significant risk transfer process, through the prudential calibrations. So at the moment, for many issuers, the economics don't work, and the same for investors. I mentioned insurance companies. Clearly, for an investor, securitization can offer nice exposure to certain asset classes through a liquid instrument. But if you have to do all this due diligence work that is, not comparable to other fixed income asset classes, because it's a lot that investors have to do just to buy an STS securitization, then the economics don't work, and for insurers, we're seeing that Solvency II, even with the recent revisions, has not incentivized them to return to the market. So further work on those areas is needed.
Yes, thanks, Pablo. Before passing on, it's an ironic in a way. A product that's meant to be simple and transparent is anything but anyway, it appears. Patrizia, over to you. Thank you.
Good morning, and thank you for inviting me to this panel. So I'll shift a little bit the focus to non-performing, which is a very relevant topic if we look at the question of the title of this seminar, this panel. What is the future of securitization? And securitization is heavily used to support the bank's effort to deleverage and to dismiss non-performing assets. So that's my topic today. Okay. I'm going to start by framing the macroeconomic situation because that's relevant to draw conclusions about the NPL securitization market. I'll do my best to go quickly through the first few slides in order to reach what I think are the key points, the important points of these few minutes I have today. So we see in this slide a very quick summary of the macroeconomic situation. The picture is that of an unprecedented, very significant crisis that is affecting both demand and supply side, with many economic activities interrupted, job loss, income loss, a very high degree of uncertainty, drop in consumption, drop in investment. Given the situation, the authorities have been very swift and in giving a strong and determined response to the crisis. They introduced measures of all sorts and managed to support quite nicely all sides of economies. So monetary policies, fiscal policies, and legal measures. I'm not going to do the details. I expect most of us, most of you know all these details. In the next slide, we zoom in on the regulatory response to COVID. Regulatory response has been developed mainly in three directions. One is the easing of regulatory pressure. So, for instance, flexibility in monitoring the achievement of NPL targets for banks, or banks temporarily allowed to operate below the thresholds of Pillar 2, capital conservation buffers, liquidity coverage ratios, and so on. Second direction has been the relaxation of regulatory agenda where possible. So, meaning calendar for supervisory activity and on-site inspections postponed where possible. And thirdly, banks, of course, have been asked to carefully monitor their risk positions on a continuous basis. On the next slide, we go on and look at the results of these measures. So what have been the consequences? Well, first of all, and most importantly, economies have been surviving. But also very important for the banking books is that the bank's lending has been massively boosted because of measures like payment holidays, government guarantees, and so on. These measures have prevented banks from marking loans down as much as they would have normally done. Interestingly, is that a side effect of all these measures is what we see in the next slide, and it has to do, slide 5, it has to do with the number of bankruptcies practically in most countries. Counterintuitively, the number of bankruptcies in most countries has gone down in 2020. I picked 3 countries. I just thought, three, two of the largest economies in Europe and obviously the US. But you see this pattern in most countries. These charts show the number of bankruptcy cases for these 3 countries for the past 10 years. So what we see is that since 2008, as the economies were recovering from the crisis, from the 2008 crisis, over time, the number of bankruptcies has been constantly decreasing. Now, in 2020, given the crisis and how difficult it is for companies to cope with the current situation, we would expect that the number of bankruptcies, we would expect that number to increase. But in fact, because of the boost in bank lending, the number of bankruptcies has kept decreasing this year. The economy is very stretched, very difficult to survive, but the bank lending has supported the businesses. Interestingly, if we go to the next slide, slide 6, we see that actually unanimously the same national statistics offices that they provided the data for the previous slide show that they have not particularly optimistic expectations. So the wide light blue band that we see across these charts shows the expectations for the number of bankruptcies for the next 2 years. And unanimously, all national statistics offices expect an increase in defaults. So this is one data set to show that generally everyone expects defaults and therefore non-performing assets on banks' balance sheets to increase. The question is not so much if they will happen, is more when they will happen. On slide 7, we look very briefly at the macroeconomic outlook. The relevant, I don't want necessarily to focus on the specific 7 versus 9% or whatever, because different research groups of economists have different conclusions. But the most important thing is that there is a unanimous view that the macroeconomic outlook is negative, with expected sharp contraction of the real GDP, a sharp increase in unemployment, massive public debts, and so on. And that's another factor to keep in mind, because there is a strong correlation between GDP and defaults in countries, obviously. On slide 8, we see that the boost in lending. So what is this slide about? So the boost in lending is putting pressure on banks' balance sheets, and that has been clearly perceived by the markets. One symptom of that is the high volatility of the banking sector in capital markets. The chart on this slide shows the price over NAV for 24 banks geographically distributed all over the world, mainly in US, Asia, and Europe. For each of these banks, we have three bars, and each of these 3 bars shows the ratios at 3 points in time: the year end 2019, end of April 2020, and end of June 2020. And the main point of the chart is that bank valuations dropped in all countries worldwide. Already in the first half of the year, the market started getting nervous about the banking sector, and that's because of the impact of the COVID-19 crisis and the impact it has on the quality of the assets of the banks. There are also some other points. For example, we see that the US banks dropped less. That's because of their higher profitability. But in general, the main point is the banking sector has been providing so much support to the economies, and by doing that has increased its exposure to risk. I also want to make one additional point, that if we look actually at the specific banks, there's another factor that is very important and affects banks differently. Banks more exposed to SME sector have suffered more volatility. We're going to see that point also in another slide. So on the next slide, so what is the outlook for the non-performing exposures then? What do we know, and what can we expect? First of all, we know that there is a very high degree of uncertainty. We know we are going through a crisis, but this crisis is very difficult to compare to any other crisis any of us here on the line has ever experienced. Secondly, we are not seeing an increase in NPEs in the short term. We haven't actually seen yet a significant decrease in NPEs. And that's because of all the measures implemented to support the bank's lending. As a consequence, banks' books are not really moving. And they're not producing the NPL flows that they would normally produce without the public guarantees, for example. Thirdly, the common expectations is that when all these measures will be phased out, banks will start applying cautious scrutiny to their lending book and will have to reclassify many borrowers to default positions. Finally, even though the priority now is to support the economy, everyone expects that it will be banks will soon feel regulatory and supervisory pressure to monitor their risk positions, to maintain the credit quality of their portfolios. And the results will be more borrowers classified as defaults, and banks significantly increasing their provisioning. In the next slide, slide 10, we see the increase. Well, this is a very important slide because the increase, so everyone agrees that there will be a strong increase in NPLs over time. but the increase will not be homogeneous across sectors and therefore across countries. NPLs non-performing assets and defaults will increase in all sectors, but some sectors are more vulnerable. Sectors that are particularly exposed to the current crisis are, for instance, hospitality, transportation, trade, both retail and wholesale trade, real estate, construction. Therefore, as a conclusion, banks that are more exposed to those sectors will suffer more. But also, so for instance, just to make a few examples, Northern European banks tend to be less exposed than Southern European banks to the hospitality sector. But then, for example, the Scandinavian banks tend to be more exposed to commercial real estate. Or, for example, even comparing two Southern European countries, both Italy and Greece are very exposed to the hospitality and tourism sector, but Italy is also very exposed to manufacturing. So, it's very difficult to generalize, but obviously the exposure to vulnerable sectors will impact bank differently, and therefore different countries' system. Also, another factor to keep in mind is that sectors will be hit with different timing. For instance, the impact on hospitality and tourism is very sharp, very immediate, but also recovers very quickly. Manufacturing is impacted less in the short term, but the recovery is much slower. And just to go to the opposite end, real estate is probably the laggard in suffering the impact of the COVID. Because initially you have all the constructions continuing and all the lease agreements are not cancelled, but with time, after 6-12 months, tenants, both commercial and individual, some will struggle renewing their agreements and so on. So that's when the impact will be felt in the real estate. And finally, as we already mentioned, another aspect to keep in mind is the size of the companies, because SMEs find it harder to survive crisis than larger companies. In conclusions, countries and banks that are more exposed to vulnerable sectors and SMEs are going to experience much higher defaults and non-performing loans than banks in different countries. Next slide, slide 11. Okay. Why are we looking at this? We're looking at this because another important factor when we form expectations about the quality of assets in the different systems is the conditions of the banking system in that specific country before the crisis. Good factor is that in general, since 2008, banks have made a huge efforts with deleveraging and improving their balance sheet. With a lot of attention from regulators. Asset quality has massively improved in all banks and banking systems all over Europe. For instance, I just put one chart for one country. It's the Italian banking system between 2008 and 2019. We see that the NPL stock has peaked in 2015 and has decreased since. So much so that at the end of last year, the stock was less than half of that in 15. This is clearly an achievement, even though Italy historically reached much higher volumes of NPLs than other countries in Northern Europe and started the deleveraging later in time. In conclusion, very important factor to keep in mind, the lower the stock of NPLs at the onset of the crisis, the better positioned are those banks to optimally deal with a new wave of NPLs induced by COVID. In conclusion, I think we get to the next slide. So what's the outlook for NPLs for the next year? Hopefully we'll soon start some economic recovery. It's generally expected to be a long recovery, not a V-shaped, but a U or L-shaped. Banks lending will slow down. New loan disbursement is expected to decrease as the measures will be phased out. Credit standards will tighten because of the deteriorating economic outlook and the increased credit risk. The experience in 2008, 2009 means banks are now less risk tolerant. And in conclusion, the general expectation is that defaults will increase and a significant inflow into the market of several NPL portfolios will start. Securitizations, as usual, as always, has been the main tool to deal with them. Yeah, so there's a huge expectation starting from maybe quarter two of next year to see a lot of securitized portfolios for NPL assets. Thank you.
Thank you, Patrizia. I mean, how do you, it's interesting that you expect an uptick in, before I pass on to Bart, in NPLs being securitized into the market, mainly, but not only, coming from SMEs. Now, we saw in one of the very early slides, I think the one that Pablo put up, was that only 2% of the market was SME based in terms of securitization. So how do you reconcile that? I mean, it's a very, very small component of the STS market as it is, and perhaps, you know, we can confine it to that for the moment. How will that translate itself in that uptick in SME and NPL loans into the market?
Well, it really depends on the, you know, as I said, this topic is very difficult to generalize, and but some systems are really, some banking systems are very exposed to SMEs. For instance, well, Italy definitely is very exposed to SMEs, and currently, even before COVID, roughly 40, sorry, I'm citing by heart, so don't, you know, but between 40 and 50% of all non-performing of performing portfolios that came to market, even in 2019 and 2020, tend to be made of SME loans. Obviously, not all countries are so exposed to SMEs, but that's one of the factors. Obviously, it's, you know, it will be very important to see from bank to bank and from banking system to banking system the exposure to SMEs, to specific sectors, the vulnerable sectors, and to determine where the fragilities are.
Right. Yeah. Good point. Passing on to SMEs and the like, over to you, Bart.
Thank you very much, Jean-Jacques. For the sake of the nearing the end of the seminar, I will keep it brief. I do not present with any slides, but I just wanted to touch upon what we saw from the graphs that were presented by Pablo, Portugal, is that the share of SME loans basically over the last years basically being securitized fairly limited proportion of the securitizations placed on the market basically consist of SMEs securitization. In a recent report of the European Court of Auditors, there was quite some critical and remark by the court stating that one of the objectives of the European Commission with the Capital Markets Union is to use the securitization as a, if you like, engine to free basically bank capital by securitizing SME loans. So that's quite a critical comment that the European Court of Auditors made. My point of view is, and that is, as a lawyer, I always tend to go back basically to the history of the law making and what the legislator indeed had tried to pursue with the new law. And in its nature, basically, I think by design, STS securitizations are an impediment to SME securitizations for a number of reasons. If securitization needs to meet STS criteria, one of those criteria is homogeneity, and there is nothing like an homogeneous SME portfolio that you can securitize. So it's very simple that is quite an impediment. But my point of view is also that the Commission intention never has been to bring SME loans within the STS framework. What we do see in the numbers of Pablo that we've seen, there's a small proportion of those STS securitizations still being the asset class SME loans. I think that the explanation for that could be that we have also seen some activity in the market, parties bringing legacy transactions basically within the STS framework. So it might be that that is an explanation. But as an academic, but also as practitioner, basically, I think it is the analysis is that it is very, very difficult to fit basically an SME securitization within the STS criteria. And therefore, basically, I think other options were also flagged by Pablo, also by Bertrand, is that I think that balance sheet synthetic securitizations, and not arbitrary ones, but will be more appropriately addressing risk transfer for banks in respect of SME loans, and creating relief that will support the financing of the real economy. And for that, basically, we need a framework. Now, based on the work of the fantastic work, I must say, from the EBA last autumn in 2019, with the proposal for STS criteria for synthetic securitizations. As we've heard, basically there's currently a negotiation pending on the rules that need to be adopted to amend basically the securitization regulation. Now, from my point of view, the analysis is a bit of a paradox because what we try to achieve basically is create a framework for STS securitizations for balance sheet synthetics, and this being had the former product of the devil, had the credit default swaps and market was quite problematic, had a really very bad reputation in the past. So this is going to be quite a challenge also to convince ultimately investors or protection sellers, basically, in respect of providing that protection within a synthetic securitization, particularly in view of COVID crisis, and as we've just heard from Patrizia, the forthcoming and the expected increase of defaults, particularly also in the SME. In the SME sector. If that's going to be true, then the timing for the introduction of synthetic securitization meeting STS criteria with a portfolio that is full of credit events, if you like, then that is going to be quite problematic to successfully launch. So we have to see. First, I think we should finish rapidly because it's been taking too long. The regulatory framework for synthetic securitizations, and particularly to accommodate the SMA, but then it will need quite some convincing of investors, basically also structuring of the underlying portfolios, certainly in view of the track record that is likely to be starting building up in the forthcoming months. as a result of the COVID crisis. So the question is whether or not we will see a successful launch of STS synthetic securitization shortly because of these factors. So I would like to leave it with this, Jean-Jacques, to allow perhaps a few answers to questions raised by the participants to the seminar.
Yes, thank you very much, Bart. And in fact, we've just been allocated another 10 minutes for questions, quite a which have come in. Before I could talk about one question raised by, I think it was Francesco Nobre, in respect of synthetic structures, and you were finished up on that, Bart. And how do we treat that, the spread, the excess spread on synthetics, as we're about to go and roll that out potentially within the STS framework? How would you treat that? How would you think about treating? In fact, that's a question to everybody on the panel.
Yeah, this is exactly where Pablo was touching upon. This was one of the elements that were included in, let's say, the recent proposals. Yeah. It is a problematic one to be solved. Here, basically, it seems. And perhaps Pablo can jump into it. Here it basically seems a sort of mistrust of the legislator in the market, because at the end of the day, I think pricing of these structures should be more a market based on the market dynamics than it should be a legislator basically imposing on the market participants basically what an appropriate spread structure should be. But here I think it's an expression of the mistrust of the legislator, the politicians basically in the product. Okay, perhaps leave it for that, and perhaps Pablo could give some further comments.
If I may, this is Bertrand Chavasse speaking. What we observe in this proposed definition is that, as you said, maybe there is a misunderstanding. In terms of market practice, we see two kinds of synthetic excess spread. You know, the synthetic excess spread is a commitment by the originator in synthetic securitization to absorb a given portion of losses during the life of the transaction. And what we observe is that usually the synthetic excess spread is calibrated as being equal to the 1 year expected loss. So somehow it means that every year, statistically, at inception, conceptually, the expected loss will be retained by the originator, but it won't absorb the unexpected loss of the portfolio. So the loss above the statistic loss expected. Yes. And in the current definition, what it is suggested is that at inception, originator will have to consider the whole life of the excess spread committed as a first loss tranche. So it will have to deduct the duration time this committed excess spread, the yearly committed excess spread at inception. And we think that conceptually, linked to the fact that it covers only expected loss, it's not appropriate because somehow deduct this lifetime excess spread at inception means that the originator is retaining a first loss that will be exposed to unexpected loss, which is not the case. And especially when it comes to the kind of structure which has use it or lose it excess spread, i.e. that if there are no losses on a given year, then the synthetic excess spread that was committed cannot be used on the following years, which is not the case of what we call trapped excess spread, and which is captured by another part of this definition. So we think that here, simply it will completely, if it stays in that, if it stays as such, it will completely remove any usage of synthetic excess spread, which is a clever way to transfer to third parties the unexpected loss of a portfolio, but not the expected loss.
Pablo, do you want to come in on that as well?
Thank you. I mean, Bertrand was very comprehensive. I would just say, in terms of process, we think this is an issue that should be considered in the future review of the framework next year, and not kind of rushed in the current capital markets recovery package, because it is a very complex issue. The EBA, as I mentioned earlier, has just issued a report on SRT, which recommends the consideration of excess spread. But that just came out, and we think this needs to be thought through given the complexity of the issues. I would just note, in terms of the economic recovery at the moment, the European Investment Fund has been investing in a lot of transactions this year with banks that use excess spread. And, I don't want to put words in their mouth, but there would be concerns if those transactions are no longer possible, those types of transactions that the EIF has been supporting, if these regulations are applied, So that is a concern, because, we need financing to flow to SMEs at the moment, and we need securitization to be used for that purpose.
Thank you, Pablo. It's just, I've made some notes as we were going through the discussions, and there's a couple of things that come to the fore. Words like suspicion of regulators and lawmakers of securitization, mistrust, disincentivization. These are all kind of quite significant indicators of the state of the market. And so when we go back to our original question, which way forward? What is the way forward when we're talking about mistrust and suspicion and disincentivization and the like? I mean, it seems to me that we are at a crossroads whereby something needs to be done in order to move the market forward, particularly in view of the fact that at this point in time, the issuance by the end of this year will be lower than it was in last year and before that. So, how to not necessarily kickstart it, but dare we say, keep it going with these sorts of words in place. What do we sort of think are the key objectives that we should go for? And perhaps I could start with you, Patrizia, to get your sort of comment on that.
Sorry, I was very sorry. I was very focused on replying a question. It seems to me that Pablo and Bertrand have already discussed this topic. You're touching again on the distrust and sort of like
go forward. Yeah, how are we going to move that? How are we going to remove the mistrust to actually open the market out and to have more interaction between market and regulators, so some of these issues that are the barriers that Pablo rightly listed can be removed or can be mitigated?
Well, there are the way forward to remove this mistrust is actually to keep an ongoing dialogue. And to be honest, I perceive this mistrust on both sides, but I also see there are many efforts of dialogue. There are many papers and that are sent to the market looking for comments and feedback. There are many opportunities for markets and regulators to meet and receive comments. I think it's the only way forward and overcome this mistrust is really to keep the dialogue open and probably opening it even more and understand where this mistrust comes from and why mistrust in general originates from the fact that a part doesn't understand, that doesn't feel understood, and market practitioners at the moment are extremely frustrated because a lot of the activity has been easily become impossible, because of so many formalities and so many exactly requirements. That's very frustrating, obviously, and that's not what the regulator wants to achieve. So So I want to be hopeful and positive. I think we keep moving in the right direction, but the only way to overcome mistrust is really to listen to each other and to have as many opportunities of dialogue as possible.
Any comments from the other panel before we wrap up, because we've now had our 10 minutes? Pablo.
I would just say that, I mean, the Commission has done a lot to overcome that mistrust, the Commission and the EU authorities, by establishing the STS framework. So for us, that is really a key pillar of, you know, overcoming that stigma, you know, to show the market that we have these best-in-class securitizations. So I think we've done a lot of the work already. The question is just around calibrating that framework correctly, making it sufficiently risk sensitive to reflect the standard of those securitizations. And I think there's further work to do, but the market has been given a very clear signal by the regulators. I think we need to do some fine tuning to that framework. Some of the treatment still reflects the crisis, the bad performance, and the disaster of the US subprime market. We need to kind of be a bit more optimistic around the strength of European securitization and STS going forward.
Yeah. Thank you very much. Bertrand, before we wrap up, any comments on that? How we break the mistrust?
Yeah, maybe a last point, at least on the source of this mistrust. I think that the securitization market, as it was before the crisis, is not at all the same today. Maybe the mistrust of politicians and legislators is due to the fact that this subprime crisis has severely hit European banks, and that maybe there is a mistrust of the fact that banks could hold securitization product on their balance sheets. I think that things have really completely changed. Why European banks were holding a securitization asset in their balance sheets was based mostly in, let's say, loophole in the regulation, and I'm talking about the Basel I regulation. And there was a lot of ABCP conduits held by, let's say, second tier 2 banks, full of US RMBS, etc. And all these things were possible because the regulation was not fitted to such kind of structure. Today, it's not at all possible. So this risk and this mistrust should be or should disappear because we are not talking about the same thing.
Thank you. Bart, any final comment from you?
Yes, well, I would like to echo basically Pablo's comment here. So I think the legislator has spoken. There is a framework. The market needs to the various possibilities that are included in that framework. I would also think that the market should avoid over-engineering structures and to try to indeed truly work on simple securitization. So some asset classes might not be suitable to fit into the STS framework, and let's not try to engineer basically structures into that framework, but to keep things simple so that ultimately the market will understand that STS securitizations are first class, almost risk-free transactions, and then market pricing will follow. I think there is also a risk of over-engineering, and therefore I'm personally not that positive or optimistic about introducing too much, if you like, exotic asset classes into it, including NPL. I'm worried about the attempts basically to do that. Before the financial crisis, NPL securitizations were quite difficult, and I think it will be very difficult to blur basically the reputation of securitizations with over-engineered transactions or complex asset classes. So that's basically what I would like to say. Yeah.
Thank you very much, Bart. Actually, very interesting point. A lot of ideas come off the back of that. Don't over-engineer. Don't try and shoehorn NPLs into the STS market, etc., etc. So we're not. We've come full circle in a way. We still are some way removed from the simple and transparent underlying the STS market. We're going to have to finish our discussion today at this. I think the fact that it's overran by another 15 minutes, I think, is a reflection of the interest that both the debate and the feedback from our participants on the presentation has we've seen. One point I do want to make for everyone is that the slides and indeed the debate today will be available on the FBF website, and so you can reflect on some of the issues raised in that discussion. And I think with that, I'd like to bring the debate and the online seminar to an end, and to thank again all participants and presenters. And thank you very much, and have a pleasant remainder of the day. Thank you. Bye-bye.